China's car makers just captured 32% of every vehicle sold on Earth. Their electric vehicles now make up 61% of the entire global EV market. And on average, every one of those cars earned the company that built it about $2,000 in gross profit, before operating costs, before research and development, before a single yen of overhead gets paid. That is not a typo. $2,000 is the markup on a mid-range laptop, not the margin on a machine that costs $30,000 to build, ship, and warranty. Throughout 2025, over 70% of new cars sold inside China were sold at a loss. 16 major manufacturers cut prices anyway, in the middle of that bleeding, on purpose, while the rest of the industry watched and waited for the whole thing to collapse. It didn't collapse. China didn't lose the EV race in the process. It won it outright, and it's still winning it right now while you watch this video. This is the story of how an entire country figured out that you don't need to make money on the product, to make money on the war. By the end, you'll understand exactly why the rest of the world's auto industry is genuinely afraid of a country that can't turn a profit on its own best-selling product, and why that fear might be the smartest reaction anyone in this story has had. If you want the next one of these the moment it drops, hit subscribe now. It takes about 2 seconds, and it's the whole reason this channel can keep making them. For over a century, the car industry ran on one rule nobody questioned. You build a vehicle, you price it above what it costs you to make, and the gap between those two numbers is your margin. Every automaker on Earth treated that rule like gravity. General Motors accepted it. Toyota accepted it. Volkswagen accepted it. Even in the leanest years, when margins shrank to 2 or 3%, nobody went negative on purpose. Selling below cost was something a company did by accident, right before it went bankrupt. It was never a strategy. China entered this industry from the bottom of that pyramid. Through most of the 80s and 90s, its domestic car market existed mainly to host foreign joint ventures. Volkswagen built Santanas in Shanghai starting in 1985. General Motors built Buicks in that same city more than a decade later. Beijing Jeep assembled Cherokees under a similar arrangement. Chinese firms supplied the labor and the factory floor. The engineering, the patents, and the profit stayed in Wolfsburg and Detroit. Here's the part that made the gap feel permanent. A Chinese-branded car in the mid-90s was, by global standards, a punchline, underpowered, built from thin steel with no crash safety worth mentioning. By 2000, foreign joint venture brands controlled well over half of China's own domestic passenger car market, inside China's own borders. The internal combustion engine took Germany and Japan roughly 100 years to perfect down to the last gasket tolerance. China had no comparable head start, no legacy supplier base, no century of institutional knowledge in machining a crankshaft to a few microns. By every conventional measure, closing that gap the normal way, one incremental improvement at a time, would have taken decades China simply didn't have. By the 2000s, the incumbents looked untouchable. Toyota was selling more vehicles worldwide than any company in history had managed, an empire built on the Corolla, the Camry, and a manufacturing discipline copied in business schools everywhere. Volkswagen owned brands spanning from the people's car to Lamborghini, and its Chinese joint ventures alone generated a meaningful share of the entire group's global profit. General Motors and Ford had spent a century building dealer networks and supplier relationships that a new entrant couldn't replicate just by writing a check. Detroit, Wolfsburg, Toyota City, and Stuttgart controlled the technology that actually mattered. The combustion engine, the transmission, the emission systems regulators demanded. That kind of infrastructure isn't built in a single boardroom meeting. It's built over generations, through recessions and oil shocks and recalls that would have finished off a lesser company. Beijing understood the size of that wall as well as anyone. China had spent years trying to build a homegrown combustion engine industry that could compete on quality, and every attempt ran into the same wall. You cannot out-engineer 100 years of accumulated expertise inside a single 5-year plan, no matter how much money you throw at the problem. If China wanted to beat the incumbents on the incumbents' own technology, on their own turf, it was going to lose permanently. So in the mid-2000s, Beijing made a decision that looked reckless on paper. Instead of trying to build a better combustion engine, it decided to make the combustion engine irrelevant altogether and it was willing to burn a genuinely staggering amount of money to make that happen. If you're enjoying how this one's shaping up, now's a good time to hit subscribe, because what China built next changed the entire physics of the car industry. Here's the honest reason China's price war doesn't play by the rules everyone assumed applied. In a normal market economy, a car company that loses money on every unit for long enough goes bankrupt. Investors pull out, banks call in loans, and the company either fixes its costs or it dies. That discipline is exactly what stopped Ford and General Motors from just flooding the market with cheap cars to bury Toyota back in the 1980s. It wasn't a lack of desire. The math would have destroyed them first. China's EV sector was never fully subject to that discipline, because a meaningful share of its capital never came from investors expecting a normal return. It came from provincial governments competing with each other to host a factory, offering free land, cut-rate loans and tax holidays, because a factory means jobs and jobs mean political credit back to Beijing. It came from national subsidy programs that have funneled well over $100 billion into new energy vehicles since the late 2000s. BYD alone received close to $4 billion in direct government support between 2018 and 2022, including more than $2 billion in 2022 alone. Chinese economists actually have a word for what happens when this kind of competition spirals with no natural stopping point. They call it neizhuan, or involution, effort multiplying endlessly while the reward for that effort shrinks towards zero. It gets worse before it gets better. The flaw in the old assumption was never in the accounting. Losing money on a car is still losing money, no matter who's counting it. The flaw was believing every company in this race was playing the same financial game everyone else was. Most of them weren't. Wang Chuanfu didn't start out trying to build cars. In 1995, he founded BYD as a rechargeable battery maker in Shenzhen, competing against Japanese giants like Sony and Sanyo with a fraction of their capital. His method was almost embarrassingly low-tech. Where Japanese rivals used expensive automated production lines, BYD broke battery manufacturing into small manual steps cheap labour could perform by hand, then slowly automated only the steps that actually mattered. It wasn't glamorous. It worked. Within a decade, BYD was one of the largest battery suppliers on the planet, and it had learned a lesson its rivals hadn't. Owning the component underneath the product matters more than owning the product's badge. Cars came later, almost as a side bet. In 2003, BYD bought a struggling state-owned automaker nobody else wanted, and the company's own stock dropped by roughly a fifth the day investors found out. Most analysts at the time treated the new auto unit as a rounding error next to BYD's real business, a pet project that would either fold quietly or bleed the balance sheet for years. BYD had no experience building a car frame, no dealer network worth mentioning, and no combustion engine technology that could compete with Toyota or Volkswagen. If it had tried to fight that battle on Detroit's terms, it would have lost within a decade, the same way most Chinese automakers of that era eventually did. But Wang already understood something the rest of the industry hadn't priced in yet. He wasn't running a car company that happened to need batteries. He was running a battery company that happened to be getting into cars, and batteries, not engines, were about to become the single most important component in the entire industry, the one component China could actually own from the ground up. That insight became national strategy faster than almost anyone outside China noticed. Beijing had already been trying to solve the same problem Wang solved on his own. In 2009, the government launched a pilot program bluntly named 10 cities, 1,000 vehicles, seeding a handful of cities with subsidized electric buses and taxis, just to prove the technology could work at any scale at all. Consumer subsidies followed soon after, worth an estimated $1,500 to $2,000 per vehicle, before the program was wound down at the end of 2022. New energy vehicles had already been exempted from the standard consumption tax back in 2008. By 2015, electric and hybrid vehicles were written directly into the Made in China 2025 industrial plan as one of the sectors the country intended to dominate outright, alongside robotics and semiconductors. 13 priority sectors were named in that plan altogether, and electric vehicles turned out to be the one where the return arrived first and arrived loudest. The logic was blunt, and in hindsight, correct. China could spend another 50 years trying to out-engineer a German combustion engine and still lose. Or it could pour state resources into a technology new enough that nobody, not Volkswagen, not Toyota, had a 100-year head start in yet. It's the same playbook Beijing later ran on solar panels, where Chinese producers now supply roughly 95% of the world's polysilicon. Local governments piled on top of Beijing's national push, competing to host EV factories with land grants and cheap financing, because a car plant meant thousands of jobs inside a single district. By the early 2020s, close to 500 separate companies had registered as EV manufacturers in China. Almost none of them had any real obligation to turn a profit anytime soon. By 2023, conventional business logic said this could not last. You cannot run an industry where most of the players lose money on every unit sold, not for years on end, without the weakest going under, and the survivors eventually raising prices to recover. That's how every price war in the history of capitalism has ended. And it doesn't stop there. Battery cells, the single most expensive part of an EV, cost real money regardless of who's making them, and lithium doesn't get cheaper just because a government wants it to. But China had already reframed the entire question. It wasn't asking how to sell a car profitably. It was asking who could survive longest without needing to. When BYD's own chairman was asked directly about the price war in 2023, he told investors the company was prepared to fight it for another 3 to 5 years, and that he was confident BYD would come out the other side with more market share, not less. Picture two divers racing to the bottom of a pool, except one is wearing a tank and the other is holding his breath. On the surface, it looks like a fair race between competitors. Underwater, it isn't close. China's EV makers had state loans standing in for oxygen, local governments subsidizing their factories, and in BYD's case, ownership of its own battery and increasingly its own chip supply chain, stripping out entire layers of cost that Western rivals still had to pay outside suppliers to cover. Every lap, the incumbents swam on their own lung capacity. China's national champions swam on borrowed air. The proof it worked wasn't a projection. BYD's own gross margin on its automotive business actually rose from roughly 21% to 28% between early 2023 and early 2024, even as its average price per car fell by nearly 18% over the same stretch. This is not proof China has already won, and pretending otherwise would be dishonest. The oxygen tank strategy has a body count and it isn't small. WM Motor, once one of China's largest EV startups, filed for bankruptcy in 2023 after selling roughly 100,000 cars. Human Horizons, the company behind the futuristic hi-fi brand, halted production in early 2024 and filed for restructuring months later. Jiuyue, a joint venture between Geely and Baidu, collapsed within about a year of launching. Neta, once the top-selling Chinese EV startup with nearly 500,000 cars sold, went bankrupt too. Since 2020, more than 20 EV makers have left the Chinese market entirely, leaving an estimated 160,000 owners without software support or spare parts for cars they already paid for. That number sounds impressive, until you remember the strategy also triggered a defensive wall going up around the rest of the world. The European Union now levies tariffs of up to 35% on Chinese-made EVs. The United States and Canada raised theirs to a full 100%. Those markets are, for the moment, functionally closed. The math only holds if you zoom all the way out to the national level. China's factories can now build 55.5 million vehicles a year, but the country only sells around 23 million of them domestically, roughly 50% capacity utilization industry-wide, the kind of number that would bankrupt almost any manufacturing sector on the planet. Even Beijing eventually admitted the strategy had a ceiling. In February 2026, the government banned automakers from selling new vehicles below production cost outright, overruling its own price war. Nobody has tracked this long enough to know if the survivors can hold the margins they'll need once prices normalize. This is not a lab claim anymore. This is real, and it shows up in trade data any government on Earth can check for itself. China first overtook Japan as the world's largest vehicle exporter back in 2023, shipping somewhere around 5 million cars abroad, against Japan's roughly 4.3 million, according to figures from the country's own industry associations. By 2024, China's total had climbed to 5.5 million vehicles shipped overseas, and forecasts published in 2025 put the following year's total above 7 million. New energy vehicle exports specifically jumped by 77% in a single year at one point in this stretch, a pace no other major exporting nation has matched anywhere in the modern history of the auto industry. The battery side of the ledger is even starker. As of early 2026, Chinese companies control roughly 71% of the entire global electric vehicle battery market, up from around 60% just 3 years earlier. KTL alone holds close to 40% of it worldwide, running an 18% operating margin that would make most Western manufacturers jealous. BYD holds another 14%. Between just those two companies, over half of every EV battery installed on the planet, whether it ends up in a Ford, a Volkswagen, a Hyundai, or a BYD, now runs through Chinese supply chains. And the incumbents are responding in ways that would have been unthinkable a decade ago. In January 2026, Germany, the country that invented the automobile, opened its own €3 billion EV subsidy program to Chinese brands, refusing to impose any origin restrictions even as its own manufacturers struggle. The country that spent a century defining what a great car looked like is now helping subsidize its own replacement, because it no longer controls what's inside the vehicle. So where does this actually go from here? A few things look likely. First, the shakeout inside China isn't finished. Industry analysts at Alex Partners estimate only around 10% of Chinese EV brands will be reliably profitable in the coming years, which means more names like GU and Neta are probably still ahead of us, not behind us. Second, expect the export push to keep accelerating toward markets that haven't built tariff walls yet: Southeast Asia, Latin America, and the Middle East, even as Europe and North America raise theirs higher still. Third, expect more legacy automakers to quietly stop competing with Chinese battery makers and start buying from them instead, the same way Germany just chose subsidy over resistance. Fourth, expect Beijing's price floor from February 2026 to hold for a while and then crack again the moment growth slows, because the underlying overcapacity problem, 55 million units of factory space chasing 23 million domestic buyers, hasn't actually gone anywhere. And fifth, expect the definition of winning in this industry to keep shifting, away from who makes money on the car itself and toward who controls what's built inside it. That's the real answer to the question in the title. China never needed every car to turn a profit. It needed the rest of the world to become permanently dependent on what's underneath the hood: the batteries, the supply chains, the manufacturing scale. On that measure, the losses were never the cost of the strategy. They were the price of admission. So here's a question worth sitting with. If your country's auto industry ends up buying its most critical technology from a nation that spent a decade losing money on purpose to get there, is that a fair trade? Or is it the setup for a much bigger bill down the road? Let me know where you land in the comments. And if this is the kind of story you want more of, subscribe, because there's a lot more of the global economy quietly being rewritten right now.